am Deidre Quinn, and welcome to Pending and Trending, a podcast that started in real estate and grew into so much more. Here, we talk about the power of building wealth, creating opportunities, and designing a life that lasts for generations. With expert guests and real conversations, my mission is simple: to help you elevate your journey and build the legacy you deserve. Welcome back to Pending and Trending. I'm here today with Mor Milo. He is the co-founder of RELLI, a platform created to expand access to institutional quality real estate investments. Alongside co-founder Ross Steiner, he developed RELLI as what he described as the stock market of real estate. It allows investors to discover, compare, and invest in opportunities with greater transparency and lower entry points. Thanks so much for being on with us today.
My pleasure. Good to meet you.
I'm happy to have you on. Let's dive right in and get down to it. So for our listeners, can you just explain what your RELLI platform is and what problem you set out to solve when you started conceptualizing it?
No doubt. So essentially our goal is to become a stock market for real estate. What we envision is a place where you have the ability to invest in real estate with as little as $100, just like you do on the stock market in Fidelity app or Robinhood or any of your favorite brokerages. And to do so in real estate that is large, huge properties, big multifamily assets, big industrial assets, maybe a data center, things of that nature, like a high net worth investor would, but to do it in a consolidated platform where you'd be able to see your portfolio in one place and manage that portfolio as you grow from a small fractional investor to hopefully a active real estate investor in your own right, or just continue to expand your portfolio of passive investments. So what we discovered was that there was a huge market out there for high net worth individuals, but average consumers couldn't participate, and we really wanted to get in, me and my business partner Ross. So we decided to build the foundation for the platform that we wanted to invest on.
So that's amazing, and I think it's excellent that you're working on that and have done that. And I can't tell you, in all the years that I've been in the real estate world and investing world, how long, it really wasn't until my podcast that I really started meeting so many people investing in so many different ways and really learning about all of the different ways that are out there. And certainly my listeners are like, oh, wow, that's really interesting. I hadn't heard of that before, kind of thing. So I think that's absolutely wonderful that you're doing that. What's changing now that's allowing those doors to open and more people to participate?
I would say what is shifting is, number one, in our current debt market, sponsors, real estate development groups that raise capital, have been plagued with institutional investors that have shifted their energy towards debt because they have a better position in that debt stack from a risk perspective, and the returns became similar to what they could receive in an equity position. So retail investors have been what's keeping the real estate syndication fund market afloat, because those institutional investors have shifted a lot of their energy towards that debt. So those who have great relationships with their investors and good deals that could weather the storm of higher interest rates and more scarce market are succeeding. And what that has done is showed many sponsors that their reliance on one or two or five different partners that are consistent in their business and deploying capital, and I say consistent in air quotes, they had to scurry and figure out how to get a digital presence and start speaking to retail investors. So with that, in the last 5 years, post-COVID and post what's happened with interest rates, we're seeing a lot of energy going out towards the public markets for private real estate investment deals headed for accredited and high net worth individuals. And in the background, what's been happening over the last 10 or 15 years is, since the Jobs Act, that was an Obama creation, I believe, there have been more small businesses that have offered investment opportunities to average consumers by use of crowdfunding, and real estate sponsors are starting to see that as an opportunity to diversify their investor pool and to systematize the methodology behind raising capital for their deals. So the culmination of those variables all coming together in a beautiful stew is creating an opportunity for average consumers to start looking at these investments. Now, in the past, these syndications and funds were available to investors that were in the know. And for those investors, they were able to deploy 25, 50, 100,000, a million, whatever dollars into a real estate syndication with a large sum of units or a large square footage of industrial facilities or whatever the asset happened to be. They have syndicated and put their money together and deployed that capital for decades upon decades. That's how the business was built. And what's also happening is that sponsors are realizing that only maybe about 5% of people that qualify as what's called an accredited investor, which is an investor that has over 200,000 in income individually, 300,000 in income with a spouse, or $1 million in assets outside of their residential home, that only about 5% of that market has been penetrated to invest in these types of alternative investment vehicles. So with the advent of the internet and with the last 20 years of evolution around the internet, and obviously real estate sponsors are very slow, real estate investors are very slow to make moves and adjustments because it is a business that this works, let's not change it, there's no reason to make adjustments. But people are starting to really see the light and say, okay, if we can start to penetrate that 95% of high net worth individuals that don't know these deals exist but would probably be more than happy to invest in them, then they can really build a powerful business. And then if they take it to the, call it 80% of the rest of America that's not an accredited investor and offer an average Joe an investment for $100, they have just created a massive pool of those investors that they can work with to build more property, which at the end of the day will hopefully support us with our housing shortage that we currently have.
Absolutely. So, how does RELLI allow investors to discover and compare opportunities?
That's a great question. We have an online platform that's available today for investors to go see a few deals. It's about, I think we currently have 8 active deals as of this moment. We have another one that should be launching here in the next week or so from our first publicly traded customer that's on the platform, which is very exciting. But an investor has a totally free access to our online platform and to a concierge service that we provide, where we offer different deals that we've vetted from sponsors all across the country. And anytime that we get new deals, we update them when they create an account, and they can engage with us and our concierge team to learn more about how these investments work and connect directly with the operators that are raising the capital and managing the assets. So we provide a full service solution for investors to be able to find their next deal, connect with the sponsor, and learn more about who they're investing in, and deploy their capital into a large selection of opportunities.
Now, you mentioned the word vetting. What do you do to vet them, and what does that look like on your end, and how much should an investor rely on that?
Every investor should do their due diligence, no matter which way you slice or dice it. You should have your team. You should have a financial advisor that you can refer to, real estate professionals in your corner, and we can help you connect with those types of people. What we do is we attempt to manage the top tier of vetting for the sponsor. Who is this person? What's their background? Do they have a track record with investors that have received returns in the past? Do they have a deal that makes sense? Is it within the realm of possibility? And do they have enough credibility as an operator for us to feel confident that investors are going to connect with this person and be able to trust this person? So we'll look at the deal specifically. We'll look at the background of the sponsor that is presenting the deal. We'll dig into their previous deals and how much they've done in the past in that specific asset class that they're advertising on. And then we're actually in the process of incorporating some interesting tools that will be able to do background checks on SEC registrations that they've done in the past, other companies that they might have worked for or worked with to do other types of real estate deals, and a plethora of different types of background checks to make sure that these people are real, that they have experience, they have a track record of assets that have proven to be profitable, and that they have all of their legal and compliance in a neat and organized order. So that would probably take about 70 to 80% of the hard labor off the table for a passive investor that's learning how to invest in one of these alternatives for the first time. Beyond that, we still recommend that you read every page of the private placement memorandum and the offering memorandum, and you run all of this documentation in front of your financial advisory team to make sure that it fits your portfolio. Because no matter which way you slice it, it's an investment. Investments can lose money, and there's a certain amount of risk with any type of investment. Whether you're investing in a first position lien and you're in a debt position with a house or something, or you're investing in a fund of assets. They each have their own risk, and each one of them needs to be actively diligenced before investing in.
Do you have some top things that you would recommend novice investors doing this for the first time look for?
Yes. I would say first things first is talk to another person who's invested in a syndication or fund in the past and get their experience of the emotional roller coaster of what it's like to invest in a private syndication or fund, because that is a completely different experience than investing in a mutual fund or index fund on the stock market. So that would be number one, is get people in your corner that have previously invested in deals. And we can actually help connect people with that. So that's helpful. Another piece of advice that I would give is look at deals with others. And what I mean by that is actually spend time on the phone with a more experienced investor walking through the offering memorandum and the private placement memorandum. Take 30 minutes, take an hour, look at the documentation, understand what things mean, ask questions. There are no stupid questions, okay? Because you have lots of weird variables and terms and things that don't make sense off the bat. You have to get explained, cap rates and NOI and all that stuff. It's a language. So you have to immerse yourself in that language, number one. And just like any type of investing, right? If before you go invest in technology, you should probably go research the top technology firms. Before you invest in energy, you should go research the top energy firms. Look at multiple deals. That's why we have a platform. Talk to multiple sponsors. See different structures of deals, because every deal is different. So I think the most important component is education and curiosity. I would be curious, ask lots of questions, because it's a new world. And before making any sort of investment, whether it's $100 or $100,000, you should know the basics of what's available in the marketplace, what's the structure of the investments that are available, and who the operator is, including what is their previous experience doing what they're doing.
Very good. Where do you see the biggest opportunities right now for investors?
And the type of investor that you're talking about, there's obviously a wide spectrum. It depends on what type of deals you qualify for, and it depends on what your risk appetite looks like. What we have seen in the market that has been consistent in the last 2 years, 3 years has been retail, so double net, triple net lease product, which is a Sherwin-Williams or a Walmart or a shopping center, that type of stuff. That has consistently performed throughout even this weird fun game that we've been playing with interest rates and market scarcity. Whereas multifamily has had a track record of producing outsized returns in the marketplace, but has been on a much more fluctuating curve from a emotional roller coaster as well as just like perception of the asset class over the last 5 years. Is it overbuilt? Is it underbuilt? Are we building in the right places? Do we need to go to different places? It's primary, secondary, and tertiary markets and how those have all fared. There's been some fluctuation, but traditionally that asset class has produced really well because there's a need. There's a very big need. At the same time, we have a fun little debt scare that's going on in the marketplace right now where private debt is taking a bit of a hit because people are concerned with all of the maturities coming due and the lending that's been done, whether it's a advantageous position for a private investor to deploy their capital into debt. But debt has been one of the lowest risk and best consistent returners over time. So all that being said, I think what's most important is to get educated on investing as a whole. And what do I mean by that? If you're familiar with Tiger 21, it's a club of very high net worth investors across the country that have a very small, intimate community. And I believe the minimum age for an individual to join this group is $10 million. And if you look at their data, about 26% of their investment capital is going into real estate. But the remaining 75% is spread across multiple sectors in multiple areas. So just like how those super high net worth qualified buyer type investors are deploying 26% of their cash into real estate, and that's spread across all of the different sectors amongst that specific asset class, I think investors need to start looking at opportunities to build a portfolio that has a certain percentages of assets in that portfolio that have balanced their risk across their entire portfolio. So I think that education needs to happen first. And now that we have more what they call crowdfunding syndications coming to the market from real estate, I think in the next 10 years, we're going to see more of these assets going to the average consumer in a way where an investor will be able, at all levels across wealth spectrum, will be able to designate a certain percentage of their capital to each one of these asset classes within a digitized format. And I think that's going to be a really powerful tool that investors should start getting educated on, because I think that's the next opportunity for the average consumer to start diversifying their assets into investments that are based in hard pieces of property that turn a certain amount of profit every single month.
That's so insightful and makes so much sense. Now, with your platform, your RELLI platform, it's free access for investors? How does that work? Are you paid then by it? Who funds it? Who supports it?
The general partners fund the platform for the limited partners. So what does that mean? The passive investors get a free solution and a free concierge team to support them, because the real estate developers that are raising capital are looking to advertise on our platform. And what we do for them is a multitude of things. We shore up a lot of marketing work that most of them are not super familiar with doing, which helps them focus on generating returns for their investors, which is happy for the real estate developers. And the passive investors get access to a digital platform that has a bunch of different deals on them, has calculators for them to be able to calculate different returns and benchmark them against other investments in the marketplace like the S&P 500 and T-bonds and other things of that nature. And you'll also have access to our team at RELLI, which is a concierge style service where we will actually schedule meetings with those investors and show them different deals, connect them to different sponsors, show them how to use the platform. And that's all 100% free.
Love it. Love it. So you have your platform that anyone can go on right now, right? And they can check out the different possibilities through there. They can connect directly with your team and compare the deals and use the tools that you have currently in place, and you're also adding more.
All the time adding more, yes. So you nailed it perfectly on the head.
Excellent. Do you have any last share that you want to share with our listeners?
I'd love to learn what your listeners really care about. What has been the biggest feedback from your listeners that they really enjoy from watching this content? Maybe I can bring a story to the table of interest.
So what I'm finding is basically what you were explaining. A lot of the listeners, they're not familiar with all of the different, it's historically, it's okay, go to work, get a paycheck, make money, invest in your 401k, give money to a financial advisor, and if you want to accelerate that, if you want to be conservative, you're going to place it in these different diverse accounts, similar to what you're talking about, but different. And they listen to my podcasts and then they're like, wow, you know what? Like I started listening to one and then they continue listening to more because everyone has a different spin on building wealth and investing in a different way. So that's it in a nutshell.
Okay, I actually have, I think, a great story for us here. So I think the idea of investing in a piece of property and turning it into a profitable enterprise is interesting for an average consumer because it's right in front of you, right? You can rent a piece of property, someone comes in, they pay you, it's passive income, everybody's happy. What we've discovered, I spoke to an investor by the name of Eric, and Eric had been purchasing single family homes cash for the last 25 years. And what he had discovered is that passively investing, again in air quotes, passively, in rental properties was the furthest thing from passive. It was just incredibly difficult, dealing with tenants, dealing with evictions, dealing with maintenance, dealing with management, administration, where's all the money going, how's it coming in, where's it going out, accounting for it, taxes. And what he discovered is that after all of that work, he was maybe making, on a good year, 11%, 12%, on a not so good year, somewhere between 6 and 8%. And he came to our platform and was interested specifically in an offering that he would receive a 12% distribution every single year, paid quarterly, based off of his investment from debt that was placed on homes. And the conversation that we had was very pointed. I'm old, I'm tired, I don't want to keep doing this. Why do I have to deal with tenants? Why do I have to deal with maintenance? Why do I have to take care of toilets? If I just take my 20 pieces of property, 30 pieces of property, sell them and put that capital into different types of debt positions where I get paid anywhere between 7 and 12% and I do nothing, isn't that better and really actually passive? And his story is he is currently in the process of liquidating his 20, I believe it might even be 25 properties that he owns, that he bought cash with no leverage, which respect to him, that's one way to do it. And he's in the process of selling off those properties and finding operators that have larger operations than he had with teams to manage and maintain those different assets, and looking to give his capital to those people that can give him a truly passive return on his investment based on his ability to underwrite a deal and know what is good and what is bad because of his experience. So, point being, there's many ways to do this. And even those who have a long track record of a long history of investing actively are now setting their sights on different opportunities because of the advent of the internet delivering those opportunities to their front door. And we're in the process of building an engine that not only gives those investors the opportunity to learn about how they can get into these assets and truly have passive income from companies that have a track record of experience, a specific niche of real estate, and a management team to make sure that they're delivering returns for you. We're now bringing that to the front door of the average consumer. So we're excited for all of that.
That's great. That's great. So, what an amazing platform you developed. What a great story about Eric and his journey as well. And I really want to thank you so much for being on. And can you just share the best way with our listeners on how they should find you or get to your platform?
Sure. The RELLI platform is really easy to find. You go to relli.co. It's RELLI.co. And from there, you can create an account. You can see everything totally for free. You can connect with us directly for free. If you want to connect with me directly, you can check me out on LinkedIn. That's my most active social. Or you can just go to our website and schedule a meeting with us, and I will likely end up being on your call. So you're welcome to come meet us on any of our social platforms at Invest with RELLI. And you can meet me at Mor Milo on LinkedIn and reach out to me directly. And we are here to serve. So come find us.
Thank you so very much.
My pleasure.
Thanks for tuning in to Pending and Trending. Remember, generational wealth doesn't happen by accident. It happens by action. If you like today's episode, share it with a friend, subscribe, and let's keep elevating your journey together.